Hi, everybody, and welcome. I'm Leslie with the New Mexico Small Business Development Center, and I'm here with Tommy Thompson. He's going to be presenting to us Cash is King, cash management for your small business. I want to remind you, if you go to our website, you can click on a link and get the handouts for today at any time. We have those loaded. I also want to remind you that the New Mexico Small Business Development Center takes cybersecurity very seriously, and we have a series of webinars that are pre-recorded on demand to learn about the risk to your data, especially from ransomware, so take advantage of that. Also, if you have any questions, please type them in the Q&A, because Tommy is going to pick up those questions and answer those throughout the webinar. I will turn it over to Tommy Thompson for Cash is King.
Thank you very much, Leslie. Hello, everyone. As Leslie said, I'm Tommy Thompson. I'm a volunteer with the SCORE Association's Albuquerque, New Mexico chapter. My background is that I'm a retired CPA and corporate financial consultant, troubleshooter, planner, and writer. I would like to provide some guidance for you for the seminar. Your audio has already been muted. If you set your Zoom ratio on the SCORE menu on the bottom of your screen to fit window, you'll be able to see some of the type on some of the slides that we have today somewhat better. We'll also be using the Q&A function to take questions. Please write down your question and the slide number that relates to it when you submit it for us. And thanks very much for doing that. Now, we also want to talk a little bit about why this slide isn't advancing. There we go. Today's presentation is going to talk about training offerings from New Mexico's SBDC. We're going to talk about the objectives for this webinar. Then we're going to talk about this webinar. Then we're going to take your questions, and finally talk about a few next steps that you can do to help move your cash through your business more quickly and more efficiently. Now, as far as training goes, the SBDC website at www.nmsbdc.org provides a schedule of training for cybersecurity and pandemic response programs, plus a range of general business programs as well. Also, you can go to the SBDC website at www.nmsbdc.org to request no-cost business counseling, and you can also request loan application assistance there, not only to apply for loans, but also to apply for forgiveness for things like PPP, the payroll protection program that's been running around. Today, we're going to talk about cash flow and how to make it work for your business. If we're going to define it, we're going to talk about what it is, we're going to talk and what it isn't. We're going to talk about what makes cash flow into and out of your business. Now, that may seem obvious, but we'll cover the basics, but till we get to some strategic cash flow principles, some things that you can do specifically to help keep yourself conscious of cash flow in your business and also to manage that cash flow. We're going to talk about forecasting cash flow. That's a prerequisite to sort of figuring out what you have coming at you and how to respond to it. And then we're going to talk about some of those response tactics under the topic of tactical cash flow management. We're going to talk about managing your cash flow coming in and also your cash flow going out. Finally, we're going to have a few words about record keeping for the pandemic relief programs that are out there. All of them require you to keep records. All of them have an audit function of one type or another attached to them, so that the people providing you the money can come back and say, okay, did you spend the money the way we wanted you to? And then we'll talk about some next steps after that. Now, first of all, what is cash? You have to recognize that in your business, cash is king. It is the lubricant that makes the gears of business go round. It is the oil that matches up time across which you receive and distribute cash flow. And then you have to also recognize that because it's a lubricant, when it isn't there, when you run out of cash, you simply crash. Everything grinds to a screeching halt. Regardless of how many people owe you money, regardless of how many people you owe money to, without cash, none of that moves, none of that happens. Now, first of all, what is cash flow? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. A little more seriously, Investopedia defines cash flow as the net amount of cash and cash equivalents. That's stuff that turns into cash almost instantly. that are transferred into and out of your business. A company's ability to generate value for shareholders, your company, your ability to generate value for you is determined by your business's ability to generate long-term positive cash flow that isn't necessary and isn't required by any of your other stakeholders. Okay, that's called long-term free cash flow. There's no other calls on it. There's no other demands for it. It's available to the shareholders to either spend or invest the way they want to. Okay, so that's cash flow. Now, what makes it? Cash money coming in. Cash is defined as currency, as checks, as credit card transfers to your account. It's cash sales. If you have a business where you have a sales counter or a retail sales location, it's cash coming across the counter, cash coming through the register. If you have a business where you sell to customers on credit, it's collections on those sales, not the sales themselves, that represent cash money coming in. Similarly, if customers give you deposits against a future service or prepayments for a future good or service, that's cash in your hand now, but it comes attached with strings because people expect you to do something for that cash later on down the road. Also, cash money coming in can be reflected as pandemic relief loans and grants, the payroll protection program, economic injury disaster loans, the restaurant revitalization grants, the shuttered venue operator grants, the New Mexico economic relief program. All those things are cash that comes into your business. They aren't necessarily part of your profitability because they didn't come from selling goods and services to somebody. Other cash money coming in sources include bank loans. You get a loan from your friendly banker. Now, you didn't sell him anything, and you owe him the money back, so that's not part of your profitability either. Owner loans, you reach into your own personal bank account, pull out money, and put it in the business. Family and friends and fools loans or investments. Those monies come in, but your family and friends expects their money to go floating out on the water and come back with friends attached. Or whether that's in the form of a loan or dividends from an ownership interest, that's cash that has strings attached to it as well. But it is cash. It is cash coming into your business. It's cash that lubricates the gears of your operation. Now, cash money going out. Well, it seems obvious. It's anything you write a check for, all right, or anything you spend cash for. And that includes compensation, benefits, taxes. It includes payments on your accounts payable. It includes rent to the landlord, and it includes all those operating expenses that you have to make your business work over the long term. Notice I said long term. We'll talk about long term and short term a little more later. Now, cash flow is different from profitability. There are more sources of cash. We just saw pandemic relief loans, bank loans, owner loans, all that stuff. That doesn't part of profitability, but it is part of cash flow. And there are more uses for cash than just your business operating expenses. When you repay debt, that's cash going out, but it's not part of profitability. The principal portion going back. All right. When you buy capital equipment, when you improve your property or improve your manufacturing operation with new equipment, that's a use, but it's not part of profitability. Now, we've talked a little bit about what is cash flow, what isn't cash flow. Anytime you have a business transaction where there's no cash moving at the instant, that isn't cash flow, is it? Cash doesn't move, doesn't flow. And that includes things like sales on credit. Yes, you shipped the goods off your back dock, but did any cash come across the dock in exchange? No. So you've got a situation where you've got the goods out the door in exchange for somebody's promise to pay you. Well, you can't put a promise in your bank account. So that's not part of your cash flow. In the same way, your suppliers, the people you buy from, when you get goods in across the dock and you haven't written the check to send the money to the supplier yet, that is not part of cash flow because you haven't moved the cash. And we'll talk about how you make adjustments to your accounting records to get a cash flow statement as we go along this morning. Now, some basic strategy. In order to manage cash and cash flow, you have to work at it. it has to be one of the top 3 or 4 things in your mind every day with respect to your business operation. Right up there along with sales to existing customers, right up there with generating new customers, right up there with controlling your expenses. Cash flow has to be top of your mind. Okay. Now, in order for it to be there, you need some kind of tool that gives you the opportunity to look into the future as best you know it. Nobody can really forecast the future, but we can make some assumptions about it in the short term that are probably not too bad based on our prior experience in the business. And that's why we forecast cash flow. You have to forecast it. You have to have an idea of what you believe your cash flow is going to be into the future in order to react to those future consequences in time to forestall negative outcomes. Okay. You don't want bad things to happen. If you don't see the future coming at you, bad things will happen. Now, as well as forecasting your cash flow, you have to track it. You need to track it to find out why it's different. And trust me, it's not if it's different, it's why it's different. It will be different from your cash flow forecast. And you use the experience you get tracking against a forecast to refine your forecast going into the future. All right. And you don't do it just once at the start of the year. You do it every single reporting period. Some businesses are small enough that they look at their business profitability on a quarterly basis. Okay, do your cash flow forecast on a quarterly basis. Some people have a monthly look at their business results. Okay, forecast and track your cash flow on the same schedule. All right. Now, after that, after you can forecast your cash flow and you can track what's happening, now think about ways tactically to accelerate the cash coming in. Okay, I want more cash sooner. That's the whole idea, more cash sooner. And then you also want to slow down the cash going out. Notice I put a question mark there. That's not a typo, all right? Because a lot of people say to me, wow, how can I slow the cash flow down? I got to pay people. I got to pay the rent. I got to pay the insurances. I got to pay my employees. I got to do this. I got to do that. Well, yes, you do have to do that. But there are ways to think about that cash flow out and to prioritize your cash flow out and to think about it in a way that makes some sense for who gets paid first, who can be put off a little bit, especially what you can do in an emergency. All right. So we're going to talk about those things as we go along here. Now, I've talked about working at it. We're going to talk a little bit about forecasting. Forecasting starts with the idea that you have a certain amount of cash available to the business now. What's my cash right now? Now, in most cases, we start our cash forecast on the first day of the month, right? And we do it month by month. I tell everybody that I talk to, do a cash flow forecast month by month for the next 12 months, right? 12 months. And every single month, you should at least look at that cash flow forecast with an eye towards updating it based on what you know from tracking it, right? To that cash that you have on hand now, you add the cash that's coming in. You understand why it's coming in. You want to know that and when it's coming in for that next 12 months. Similarly, you want to find out and forecast what cash is going out, why it's going out, and when it's expected to go out. Okay. Rent's easy, right? You got a lease. What's going out? The rent. When's it going out? The first day of the month. Why is it going out? So I don't have to do business in the street. All right. Then you take what's my cash now, add what's coming in, deduct what's going out, and that forecasts what your cash is at the end of that forecasting period, whatever it is. I recommend monthly. You might do it differently. Okay. Now, I'm indebted to a website called neverrunoutofcash.com and an author named Philip Campbell. He wrote a book called Never Run Out of Cash, and he was kind enough to give me permission to use this template model for forecasting cash. And it has several sections, and we're going to start here with section 1, obviously. Now this looks, if you look at section 1, look at all the items that are in it. That looks a lot like your accounting profitability statement, doesn't it? It's got sales in it of whatever kind, on whatever terms. You've got a cost of goods sold in it on whatever terms that you have, that you account for it. And then you have operating expenses, compensation, benefits, taxes, and so forth. Now, it comes down to total expenses. And again, like profitability, it comes down to a bottom line. Now, in this case, the bottom line's not marked net income. It's marked with some funny acronym called EBITDA. And that stands for earnings before interest, taxes, depreciation, and amortization. And that's a proxy for cash flow that a lot of corporate analysts, financial analysts, use to estimate the operating cash flow of a business. All right. It doesn't account for timing differences, however, and we'll talk about those in another section. But for right now, the only thing different about this from your profitability schedule is that little line up at the top up here, which says beginning cash balance. And it starts out with your beginning cash balance at the start of January. I've only used 6 months of this thing, the template that you're going to get along with your slides and other materials afterwards. That template is live and it covers a full 12-month period. Then we go into section 2. Now this is where we account for interest. Remember earnings before interest? This is where we account for interest because we account for it as part of total debt service. When you make a level payment on a loan to a bank, it includes principal and it includes interest, but it's all cash. And all we care about is cash. We don't care about the division between principal and interest right now. So if you've got a bank loan, say $1,100 a month worth, then you forecast, okay, I'm going to pay that bank loan $1,100 a month on the 1st of the month or the 15th or whenever the bank wants it. And I'm going to forecast that out. Similarly, you could have other loans or things, even SBA EIDL loans, economic injury disaster loans. And the payments for those loans, all of those loans go here in section 2. Then we also have section 3. Section 3 is about investments in your business. And in general, investments in your business take the form of capital expenditures, things that are long-lived that we don't want to put on through our expense statement right away because it distorts the picture of matching our revenues to our current expenses. But we do have cash to move, and that's the cash going out the door. All right. So section 3 is all about cash moving because of investments. Similarly, if we had, for example, an account called marketable securities, where we parked excess cash for a while before we needed it, the changes in that marketable securities account would get listed here. We would either buy more and have cash going out, or we would redeem some and have cash coming in. And so that's part of the investment section. Now we wind everything up and bring it all together in section 4, which is titled Other Cash Flow Items and Timing Differences. Now, remember, our sales and our cost of goods sold generate what are known as timing differences, in that we spent the cash in the past in creating the cost that we incurred, that we recorded when the goods went out the door. So now what we're going to do is we're going to add back the cost of goods sold to our cash flow because it wasn't really cash, it was an accounting thing. Now, against that, we're going to deduct our inventory purchases. Those are the things that we actually paid for that month. All right. Then similarly, because sales of all kinds add up into this sales number, we're going to deduct that number. And then we're going to add back to it the cash we actually collected against accounts receivable and for sales that went across the counter during the month. Now, here's where we talk about taxes. We're not accruing taxes as part of profitability, but we are going to pay taxes, estimated taxes, on a certain schedule, usually quarterly. All right. January 15th, we're talking $3,000 out here. April 15th, we're talking another $2,500 out here to pay estimated taxes. Notice we haven't taken the accrued tax. We haven't considered that at all. We've only considered the cash that moves for the estimated payment that we're actually going to make when we're going to make it. Then we talk about timing changes. Accounts payable is timing, right? We get goods today in return for cash some other time in the future. Well, at the end of the month, from month to month, that accounts payable balance will change. If we pay down the accounts payable balance, say it was $5,000 at the end of January and it's $4,000 at the end of February, that means we've paid it down by $1,000, or in this example, let's call it $5,500 at the end of December and $5,000 at the end of January. That means we've paid out $500 more in paying down our credit than we actually got from new transactions with suppliers. Right? You follow that? We paid down because the accounts payable balance went down. We paid it down from the prior month. Similarly, out here in March, our accounts payable balance went up $750 from the end of February. And therefore, we got, in effect, cash in of $750. That's how that works. We left a couple of lines in there for other things that may affect your business specifically. Every business is different, and every different business is different in different ways. So that allows for some other things that may account for your specific business. Now we add all those up, $4,375 cash out is the net of section 4. And we net section 4 against section 2 and 3 and section 1 at that EBITDA line. So 6,480, in this case, minus 1,100, minus 100, minus 4,375 is our net cash flow for the month. That's $905. All right. We take our beginning balance. Remember, that was $10,000 up here. We add it to our ending cash balance, our net cash flow for the month, rather. That was $905. And at the end of the month, simple addition says we've got $10,905 in the bank. That's available to the business. Now, rinse, repeat. All right. We start February with that same $10,905 we ended January with. We add $4,475 in EBITDA. We subtract $1,100 and $1,500 in debt service and investments. And then we add $2,825 in section 4 items, right? That came out to $2,825 positive that month. So for the month, we have $4,700 in cash flow. Added to our $10,905, we get $15,605 in the bank. Rinse, repeat, on out for 12 months. All right. And you can forecast things. You know what your weekly payroll is. You know what your monthly payroll is, rather. And you can forecast that for 12 months, assuming things don't change. And we'll talk about what happens when things change in a minute. Now, a lot of businesses decide that they're going to set a minimum cash balance. They're going to set a target. We always want to have at least $8,000 in the bank. And so any money they have above that, they have opportunities to do other things with. They can send it back to shareholders. They can plan a new marketing campaign. They could plan new capital equipment purchases. But that cash is excess to the needs of the business at the moment. All right. Doesn't say it will be forever, but at the moment, it's excess to the needs of the business. Now, this example works out very nicely because we have positive cash flow all the way across the board, and our cash balance keeps growing all the way across the board, and so does our cash excess. Your business will not reflect this pattern. This is just an example. You shouldn't think that your business should match this pattern at all, okay? Because there are going to be months when you spend more than you take in, whether it's on paying back the bank or whether you have capital expenditures to do. You will incur cash flow costs beyond the money that your customers are paying you for operations. So keep that in mind. And as you build your forecast, you may have negative months, and you may want to make sure that you have the cash available to match up to what you're doing. Now, what happens when you don't have the cash available? And we're going to talk about that here. Because you're going to track it. All your major software, all your major accounting software, QuickBooks, I don't care what you're using, creates a P&L statement for you when you tell it to. It creates a balance sheet for you when you tell it to. And it creates a cash flow statement for you when you tell it to. All right. If your cash flow statement doesn't look like what we just talked about, you can often reformat that cash flow statement to match up to our forecasting web sheet over here. Or you can take that template and rework it so that it matches the format of your cash flow sheet, which lets you compare like items to like items all the way down the list. All right. That's important. You want to be able to compare like items to like items and not have to do a lot of work to reconcile your cash flow statement out of QuickBooks with your cash flow template that we gave you here. Track by month. I tell everybody, track it at least by month. If you're doing it by quarter and it makes more sense to do it by quarter, then do it by quarter. But track it at the same frequency that you prepare a financial statement, at least for your own use inside the business. Now, often you only have to prepare a formal financial statement with your accountant's letter with it. For the bank, once a year or twice a year or whatever. And I'm not talking about that kind of statement. I'm talking about the plain paper statement that happens when you push the print P&L button in QuickBooks. All right. Now, that's in the normal course of events. In an emergency, you're going to want to do this day by day, week by week, even day by day. In the 1980s, I worked for a company that made outdoor lawn and garden power equipment. And as you might think, when do people buy outdoor lawn and garden power equipment? They buy it in the spring, right? Or they buy it, on a smaller number of them, will buy it in the fall to clean up for winter. So we had a huge spike in sales in the spring and relatively little the rest of the year. And that made tracking cash flow very, very important for us because we had to make sure that we had enough cash flow in order to get through the soft period. Excuse me for just one moment. Thank you. We are recording this. So we would track our cash flow on a daily and weekly basis. The marketing department, because we sold with a specific kind of advertising program, the marketing department could forecast when orders were coming in. And they did that day by day. And if the orders didn't match their experience with when orders should be in, they could sound an early alarm. You might do the same thing in your business, but at least track your cash flow against your forecast. In an emergency, you need to break those months down into weeks or even days and look at them very closely. Now, tactically, after we forecast the cash flow and after we track it, what do we do to change it? And to accelerate cash coming into the business, what do we do? First off, the principal thing, the primary thing you have to do, sell, sell, sell. Take your existing customers first because you already have them. They're known to you. What they've bought is known to you. All right. So analyze that list of existing customers, analyze what they have bought, and then call them up, offer them a deal, offer them more of what they've bought in the past or associated, related products that will fit with what they've bought and round out their line, so to speak, or give them greater options. And related, in line with that, you want to offer them pricing discounts for fast payment when they buy more. For example, it's common to offer 2% net 10, 210 net 30 is a very common kind of thing. Take 2% off if you pay within 10 days. That's a pretty good interest rate. But if they pay with the order, you might even give them a bigger discount. All right. Say, pay with the order and get a 3% discount or a 4% discount. Now they will, or some of them will, some of them won't, it depends. But you always want to look for opportunities to get the cash more quickly from those existing customers. Now, as well as your existing customers, do not stop marketing and prospecting. A lot of businesses falsely think that they can economize by cutting down on their marketing and cutting down on their advertising during tough times. No, that's a sure way to get into a death spiral because your existing customer base will erode a little bit and it'll erode a little faster in tough times because some of them won't make it. You always have to be marketing and prospecting for new customers because you want to keep that customer base up You want to continue adding new enthusiastic customers that you've persuaded that you're their solution. All right. So do that. You want to use only one bank. One bank where everything comes into one bank, you get faster availability of your funds. It's a day or two, but still, that's a day or two that you wouldn't have if you were using two different banks for, say, credit card processing at one place and you're transferring that funds overnight to another bank or your operating bank. Now, accelerating cash flow, you can also borrow. If you borrow, you want to make sure you match the type of the loan you're getting to what that loan is paying for. For example, if you have accounts receivable balances, you can get a revolving credit line against those receivable balances, and the bank will lend you some amount of money against any of your receivables that are younger than 90 days, usually. All right. And that is typically a formula for advance. It's so much percentage of everything from 0 to 30 days, so much percentage of everything from 31 to 60 days, so much a percentage of everything from 61 to 90 days. Okay. And you can pay that up and down freely with no prepayment penalties. The bank bills you for interest on it, usually once a month, calculating the interest every day based on the balance every day. And that is a very flexible form of financing. It's short-term financing. If you want to borrow for longer periods, if say you're going to put a capital expenditure of a new machine in that has a 7 to 10 year life, for example, you might think of a term loan that is matched out to the length of time that equipment's actually going to be useful to you, okay, for 5 or 7 years. And that gives you a levelized payment that sets your cash flow. But the cash comes in now, all right? You get the cash from the loan the day it closes, and then you can spend it for the project that you had in mind. Now, collect receivables faster. Okay, how do I do that? Well, you can use professional collection techniques to make sure that your debt is uppermost in the mind of your customer, okay? The way you do that is to have cordial, courteous, professional communications with them all the time. When I say all the time, I don't mean, once a day. I mean, on a regular basis during the month, they ought to get a call just to say, hi, how are things going? Are you satisfied with what we're selling you? Is there anything else we can do for you that way? How's your business doing? And do you foresee any issues with your cash flow in the future that might affect the timely payment of our receivables? All right. That's building a relationship, and it's based on communication, and it's based on your analysis of what they are, of what their experience has been in paying you. Now, when you analyze their experience in paying you, you may find some people are habitual late payers. Now, to collect your receivables faster, you might tighten your credit requirements. In other words, that customer that always pays late, well, maybe you reduce their open credit limit, okay? So that they don't pile up as much of a credit with you as in the past. If they were open to buy it up to a limit of $100,000 in credit with you, maybe you reduce that to $75,000 or $60,000 or $50,000 for the real late payers. Your best customers, the ones that buy all the time, give them all the credit they can use, because if they buy and pay you quickly, that's a wonderful thing. Beyond tightening your credit requirements, you could say to a customer, I'm sorry, Mr. Customer, I can't do business with you on credit because you're such a slow pay. I will, however, take a credit card from you with your order, right? Now, credit cards don't collect immediately. Credit cards take a couple of days to get processed and forwarded by the credit card processing firm that you're using, but they do give you the cash much more quickly than, say, a 30-day credit, a normal 30-day term, all right? I was in a business once, different business from the outdoor power equipment, where the traditional industry, the industry credit consisted of taking a company check when the stuff was delivered, COD company check. The suppliers in that industry considered that to be credit because they didn't know if the check would clear. All right. So that was sort of an intermediate between credit cards with the order and tightening credit requirements. Similarly, And as you do this, again, it's a matter of calling and following up. You need to communicate with your customer. You can also, as I mentioned earlier, use revolving lines of credit, but I want to mention something about factoring. There are certain industries, fashion is the most well-known among them, I guess, where companies exist to buy an invoice from the selling company. In other words, they pay the selling company some amount of money, and when that invoice is due, it gets paid straight to the factoring company. There's a cost to this. It's the most expensive form of short-term financing because the factor wants to recognize the time value of money between when he pays it out and when he expects to get paid. And he also wants to recognize the risk of not getting paid and the return on investment he wants in his business. All right. So factoring frequently can have effective equivalent interest rates of 25 to 40% factored into it, which makes it very, very expensive, but it puts cash in your hand now. All right. Also, and this is a much smaller way to accelerate cash, use lockbox services with your bank. Lockbox, people mail their checks not to your office, but to a bank post office box. The bank collects from that post office box and processes that stuff the same night. And that speeds up your deposits by about a day. Now, this doesn't sound like much if your average cash receipts are $1,000 or $2,000 a day, but if they're $1 million, $2 million, or $1 billion a day, a lockbox is a big deal because it gets that extra day's float to your favor, not to the bank's. Now, we talked about accelerating cash flow in. Let's talk about decelerating cash flow. Well, the first way you should look at decelerating cash flow is to look at how you're paying your accounts payable. You have to analyze your vendor list very carefully before you do this. You have to be very aware of what vendors are completely critical to your operation and therefore have to be paid on time. And by the way, they might not be your biggest vendors. And you also have to understand what vendors you use either infrequently or rarely, and prioritize those vendors for payment. Your A group of vendors are the people you absolutely have to keep current with in order to stay in business. If they stop shipping you, you're not supplying your customers, right? They're your A list vendors. You want to keep them very happy. Similarly, you want to look at your C list vendors. These are the people where if you don't pay them right away and they don't ship something to you, you can do without it for a week or two if you have to. All right. And in between, of course, the vast middle are your B list vendors. They're the people that you could operate without for a little while, not a long time, but a little while. And they are the people that that you could do without if they got mad at you and stopped shipping or stopped providing. You could do without them for a couple of days or a couple of weeks. Now, go through that vendor list before you start to decelerate vendor payments, before you start to slow down on payments. Communicate. Tell your story. You have to tell the story in order to get their approval. They're at least understanding. Maybe they don't approve, maybe they understand why. All right. Emphasize that it's a temporary thing in general, that you are working from your cash flow forecast and tracking against that. And you see that some months out, you're going to have this issue. So you want to decelerate the payments right now with the idea that you'll bring them back into whatever the key ordinary standard terms are at some point down the road. All right. And that may be just a month or two or whatever, but you want to communicate, because if you've been a good payer and you suddenly stop being a good payer, the people that you're paying are going to wonder, oh my God, are they going out of business? What's the matter? Why haven't they paid us? And they'll start calling you. And when they start calling you, that's a different form of relationship than you being proactive and calling them to say, here's the situation. Now you're the initiator. You're the person in charge. You're the person who has the information at his fingertips, you're the person who therefore shows them that you're being a good proactive manager of your business and not just reacting in a panic when something happens. Okay. Communication is the key. Now, the second thing you talk about doing is cutting expenses. Well, that's easy for me to say, right? I'm not running your business every day. But again, you sit down and you analyze. You look at your expense ledger. What am I spending money on? How much am I spending on that function? You also have to sit down. I hate to say this, but you have to analyze your payroll carefully. Who's doing what? Are they working to full capacity? Are they doing something that I could do without if I had to for a period of time? All right. And in analyzing your expense ledger, similarly, can I cut down on spending on this particular item? This was nice. Do I need it if I'm having some cash flow difficulty? You want to then compare that analysis with an analysis of your outsourcing opportunities. Now, think about what makes your business unique. Think about how you provide value to your customer, right? What is it that your customer is getting from you uniquely when they purchase your goods or services? That's the thing. That's the kernel of your business. That's where you add the most value, and that you want to keep under your control. You want to keep that in-house. All right. If that's a design ability, keep the design ability in-house, manufacture it somewhere else. If that's a financial capability, keep the financial capability in-house and do everything else somewhere else. There are outsourcing firms that handle almost every administrative function of business. You can outsource your bookkeeping, you can outsource your accounting and tax preparation, you can outsource your human resources administration, you can outsource your manufacturing, unless that's how you add value. You can outsource your accounting, your marketing and advertising. You can outsource almost anything. And different businesses will have different outsourcing opportunities because of the way their business works. If your business is marketing and advertising, you're not going to outsource your marketing and advertising. That's what you do. Okay, so you're going to keep that, and your firm's client acquisition and client services are all the core of your business inside. But you could buy your bookkeeping services from a bookkeeping firm. You could buy your accounting and tax preparation services from an accountant, an independent accountant. You could have an HR consultant or an HR administrator administer all your HR programs and benefit programs. Okay, but that core you keep. Now, it is the most wrenching, difficult thing in business to go through your employee group and say to an otherwise good performing employee, I'm sorry, I don't have a job for you. That is wrenching. I've had to do it. I've agonized over it before I did it. I agonized over it after I did it, but it had to be done. And that is extremely difficult to do. But if you analyze your payroll ledger and decide that you can combine two jobs, or you can do without a particular function, then you need to strongly consider doing that. It is difficult, it is hard, but you need to be able to do it. Now, when you do that, the productivity of that employee is lost. If you combine two jobs, the employee doing the two jobs will not do either one of them quite as well as they were doing, unless you've got a very unusual employee. But think about how that impacts your cash flow and for how long that can go on, and just do without. We don't need to send people to that training seminar this year. We don't need that extra vehicle. We can still put a driver in this vehicle and do without the second vehicle. Whatever you do, don't eliminate marketing. You might cut it down a little bit, but don't eliminate it. You always have to continue prospecting for new customers. I call marketing the acquisition of new customers. Sales is the continuation and maintenance of customers. Okay. And your marketing also does things to make your customers feel good about dealing with you because it presents an image to the world. And customers want to be known to be doing business with good companies. So, but don't eliminate it. You still have to rebuild and continue to build that customer base all the time. Now, in an emergency that lasts like the last 16 months, okay, in an emergency, all bets are off. In an emergency, you've got to decelerate your cash flow out because your cash flow in has probably dried up. All right. You immediately start negotiating with your vendors. The idea is to delay and catch up later. All right. You want more time from your vendors. You want a higher credit limit from your vendors. You want to be able to continue doing business, but you want to be able to put off catching up. And you negotiate some sort of catch-up schedule. You know, we'll accumulate to this point, and then every month afterwards, we'll start paying down that accumulation until we're back in with normal terms, right? You want to negotiate with your landlord. Again, the idea is to delay and catch up, right? So you say with the landlord, if I can pay 50% of rent for the next 6 months, we'll amortize that amount over the rest of the lease, which is not too difficult to do if you have a lease that runs for several years more, all right? Or I need to suspend all of my rent for the next 3 months, and then we'll catch up over the next 6 or 8 months, right? Delay and catch up is your mantra. Bank negotiations, same thing. You got to talk to the bank. You got to look for some forbearance on your revolving credit line, for example. Can you increase it? Can you not pay it down? Can you be out of formula for some period of time and catch up down the road? Banks are usually somewhat more difficult to negotiate with. They have a smaller margin than your vendor or your landlord does on what they're lending you, okay? In all these cases, communication is key. You have to talk to the people to make this happen. And you have to be very comfortable about talking about it. And you have the tools to talk about it because you have a cash forecast that you've been tracking against, and you can see things happening in the future. And you're seen as a proactive, good businessman or woman. Okay, I'm sorry. Now, also in an emergency, you accelerate things. If you're in a service business, go out and offer your customers prepaid service contracts. I'll give you 12 months of service if you pay me now. I'll give you an extra month or 2 months if you pay me now, or even 3 months. Subscriptions, if you operate in a subscription kind of environment, get money for a subscription now. Promote a subscription extension now. The cash comes in now. You don't have to do it till later, okay? Restaurants, especially retail shops, gift cards, sell on the gift card front. Buy a gift card now for $100 and come back and use it in the future sometime, okay? If you do business on contract with your customers, ask in your next contract or your contract renewals, ask for an advance payment. If you have a new contract starting with a new customer, ask for an advance payment. It often takes some time and therefore some money to set up for a new customer. New customers will understand that. So you ask for an advance payment against your billings for a period of time. Similarly, in an emergency, look for disaster loans, relief programs, emergency grant programs. The pandemic have had all kinds of these available from the federal government and the state of New Mexico. Even the city of Albuquerque has had some programs like this. Look at those, investigate them, go to the websites, type in COVID emergency relief and see what's available to you. That's all cash coming in. You may have to repay it if it's in the form of a loan, or you may be able to get your loan forgiven. That's the whole idea behind the payroll protection program. All right. But look at all those things. Now, what do we have to do? We have to keep records. All of those programs I just mentioned, all those emergency programs I just mentioned, not to mention the IRS, require you to do basic bookkeeping so you can file your tax returns at the end of the year. I tell everybody, keep your bookkeeping up to date because that's the only way you know how you're doing. The only way you know if you're tracking is if all your bookkeeping and all your transactions are recorded and they're up to date. All right, there are a lot of relief programs. I just mentioned that. Each one of them has specific, sometimes different requirements as to the records you have to keep. Okay, when you get money in from one of these programs, you have two questions to ask. What is the money for? And what do I get to spend it on? When you do that in your accounting system, I tell everybody, establish sub accounts for each loan or each grant that you get, because you have to account for them separately, because the organization that you got it from may come back to you and say, show me what you spent that on. And so that's an audit, and you want to be prepared for that audit. You need to, beyond just recording the transaction, you need to keep the records that support that transaction. Payroll records, leases, utility bills, vendor invoices. You want an evidence of the payment and receipt of the goods and services in order to satisfy an auditor. Every grant or loan will have a lot of fine print attached to it. Read that fine print and then give it to your accountant. Say, I need this accounted for properly. All right. That record keeping for relief is vital to all the programs that have been established to help us through this COVID pandemic. To do that, the best way is to work with CPA or bookkeeper. Bookkeeping and accounting and tax filing are rarely things that are critical, that are part of the core value added of any business. Get yourself an independent CPA to help you with compliance, to help you with tax preparation, to help you understand what these cash flows and movements mean. And if you don't have a bookkeeper, consider getting one, whether you hire one full-time because you have full-time work for them, or whether you hire a bookkeeping service on a part-time basis. Either way, get yourself someone whose job it is to keep you up to date. Now, there are some resources beyond our little scoop of ice cream that I've given you this today. They're listed here. They'll be listed on the sheet that on the slides that you get afterwards. I want to particularly point out a couple of acknowledgments here. There's another set of resources for New Mexico's COVID-19 pandemic actions, guide to preparing workplaces, basic information, business resources down there at the bottom. I won't go into any of these in detail. You can look at them and go to the websites when you get your slide package. Contact information also in the slide package for SBDC. First of all, I would call them first, and then SBA. SBA has been very heavily hit with call volume and so forth from people interested in their programs. I would start with SBDC, and then the local office of SBA is here in Albuquerque. Those two numbers are their national contact numbers. And then some acknowledgments. I want to again acknowledge Philip Campbell and his book, Never Run Out of Cash. The National Federation of Independent Businesses has a great website with lots of resources that expand on our cash flow discussion this morning. Inc. magazine publishes articles from time to time that focus on cash flow. And finally, the SCORE Association's Albuquerque chapter, of which I'm a part, which has partnered with SBDC for this entire program set. At this point, I want to ask if anybody has any questions. I'll give you some time to write them down and forward them. Leslie, do we have any questions from the field at this point?
We do not have any questions from the field, but I do want to remind everyone that we're lucky enough to have Tommy doing this webinar for a couple months for us. Reason why I bring that up is because if you have questions that you're thinking of and you want a chance to review the information, bring your questions back next week and he can pick them up and answer any questions that come in. I also want to remind everyone that we have a whole series of webinars. We have 7 powerful offline methods to increase your business. We have a bilingual session on accessing financial resources. We have Peggy McDonough with our SCORE team coming at the end of the week about tax implications. Are you tax ready? PPP, idle, and employee retention tax credits. That's a great webinar. And also we have coming up, they owe you money. What's the next step? And I do not see any questions coming
Okay.
in. So
Well, I know I'm not that good, but thank you anyway for coming and participating today. Let's move on a little bit and talk about what's next. You can do this. You can go back to your business and start your cash flow forecast today. It starts as of August 1st because you've got this whole week to start working on it. And you can start it today and start tracking against it today, and therefore start getting experience with what changes. Every forecast that's ever been made is obsolete the instant that your pen leaves the paper. All right. And what you want to do is to track against that forecast and understand why the differences arise. Oh, I put down $1,000 a month rent. It's actually 1,200. That's experience. All right. It's a mistake to start that way, but that's experience. Or my gross profit margin has been 34% for 5 years. I think it'll be 34% for the next 5 years. And your manufacturing location rent went up with your latest lease. That's a change. Use the changes, understand what changes between what you forecast and what your actual results are. And then you can manage your business better. I hope you've all had a great opportunity to learn something this morning. We've given you some resources to follow up. Thank you all for attending very much. You can go to nmsbdc.org for further training opportunities, business counseling, loan application assistance. There are also links there to a variety of other resources that you can go to help make your business better. Now, you're going to receive a survey by email after this presentation. I really hope that you'll fill it out and send it back in, because your feedback helps me improve this seminar, both my presentation of it and the slides that you're looking at here. So thank you very much in advance for completing that survey when it shows up. If there are no real questions after that, then I want to thank you very much, everyone, for attending. It's been a pleasure talking to you. I look forward to talking with you again on another webinar. We do these on Tuesdays at 9 and Thursdays at 10 in alternating weeks. So you have plenty of opportunities to come back with any questions that you might have had later on. Thanks again, everyone, and have a great day.
thanks, everybody. You guys have a great rest of your week. See you later.